Welcome to the Rich Report, a podcast with news and information on the world of startups. Today my guest is Thomas Thurston. He is CEO of a company called Growth Science. But Thomas, welcome to the show today.
Hey, thanks Rich, great to be here.
So Thomas, I wanted to bring you on today to talk about your announcement this week that you guys have joined the Ironstone Group, an investment fund for innovative startups. Can you tell us more about that?
Sure, Rich. So I'm still CEO of Growth Science, which is the data science firm where we build algorithms to predict if businesses are going to survive or fail. And that's sort of its own deal. The new announcement is I personally have also just become a partner at Ironstone Group, which is a early stage and seed venture capital fund. And what's exciting about this is we're going to use our predictive algorithms to find and fund disruptive startups.
Interesting. So tell us more about this algorithm. I mean, do you plug in information about a company and does it spit out whether or not it's going to be a hit or not? Is that the gist of it?
Yeah, that's the gist of it. Obviously there's a lot more to it than that, but I think fundamentally we're using data science and empirical research and probabilities to find these companies that we've identified as very likely to be the next big disruptive companies or to have disruptive growth. And what's exciting for me about that is, of course, as a data scientist, a lot of the ways most VCs pick investments is they use their intuition. So they look at a company, they sort of decide in the first few minutes how they feel about it and the founders, and then they sort of go with their gut, which sometimes that works, sometimes it doesn't. But the whole venture capital industry for the decade between 2000 and 2010 actually had negative returns. So overall, it's not, intuition hasn't been a great way, it hasn't been a highly predictive way of finding out which are going to be the next big growth companies. So what's much more exciting for me personally is that we're using data science and algorithms instead of just intuition to find these disruptive companies. And that's something that's starting to happen a little bit, but is still extremely new.
Now, Thomas, you've been doing this for a while. Can you tell us the origins of this algorithm? I mean, you just didn't come up with this on a whiteboard one day.
No. In fact, we have a number of algorithms that sort of triangulate around these disruptive companies. But I think the best way to start my story, in 2005, I was at Intel Capital and started to look around the company at their investment history. And what we realized is, using at first Intel's data, we were able to find patterns of what turned out to be really great investments and what didn't. So after that, I ended up getting an invitation to go study, to be a fellow at Harvard with this professor, Clay Christensen, who's the sort of the guru of disruptive innovation, and spent over a year there working side by side with him to really bring Harvard's resources into the work we were doing and make it much more robust. So that was where it all got started, sort of between this collaboration of Intel and Harvard several years ago. And then 4 years ago, I started Growth Science, which was really my own firm where we could just focus on doing this data science using some of the learnings that we'd gotten in our work at Harvard and Intel, but really extending it forward much more aggressively and bringing in lots of other tools. So, that was 4 years ago. We basically made thousands and thousands of blind predictions over the years using these algorithms, and it's just the accuracy is through the roof as we've refined these things and tested them with both blind experiments, but also with real investors and real investments over the years.
So Thomas, as you come to use this data science at Ironstone, I understand that Ironstone has quite a legacy of success in venture capital with William Hambrecht. Can you tell us more about that?
Sure, yeah. So Ironstones actually was started in the 70s as a holding company. And, it sort of had its activity back then. In fact, it even had a one-time public offering, years ago. But then, Ironstone sort of simmered down, if you will, and been somewhat almost inactive for the last few years. Meanwhile, I've been doing all this work with Bill Hambrecht, who's a legend in Silicon Valley as an investment banker. We can talk more about him. But he had worked with me and saw our research, and we'd applied it in a number of different investment activity. And really, he said, we'd seen such great results from that work that he said, okay, let's partner up with a few other folks. Let's do a seed and early stage venture fund using these disruptive algorithms, and let's make the vehicle for doing that. Let's bring back Ironstone and make that the vehicle to kind of be reborn and do these investments going forward.
So as you guys apply these data science tools, I mean, this isn't just a matter of you reading their PowerPoint and their website and you can plug this in. You need some pretty in-depth information, do you not?
Well, actually, it's interesting that the variables at this stage, the research is so further along that we know exactly what variables we're looking for. Now, there's several of them. But a lot of these variables we can get from that PowerPoint slide and that pitch, right? That funding pitch from the entrepreneur. So we don't normally have to go and do a lot of extra research or pay for a lot of data. We've gotten really good at figuring out how to make the most or that least amount of data that you're going to see when you get the pitch. Now, I can't necessarily, crunch the algorithms sitting there in my head as I'm listening to the entrepreneur because they've gone past me. But we will be able to net the data and later come back, sometimes fill in a couple of holes, but essentially have what we need to know if it's something that fits the algorithms, or fits our investment profile.
And then I'm just curious about the mechanics of this, Thomas. I mean, do you guys just do you watch pitches that are tailored for you, or are you more just watching what's going on and picking the winners?
Well, there's a little bit of both. So we're certainly always looking for, companies that fit the model. And what's nice about variables we're looking for, so they transcend industries. So even though most of the stuff we look at is in high tech or in healthcare, it can be from any industry as long as it has the right combination. So we're on the lookout, but we're also talking to startups. So one thing I'm starting to do a lot more of is to have meetings with startups. Spend time, hear their pitch, look at their slides, and if they're sort of directionally meet our model, then we'll go in and sort of run the full thing, if you will, and go deeper and really make sure that it fits. If a startup, the algorithms say yes, this is going to be an awesome disruptive company, my partners and I will take a look and do a deal if we think it's the right fit. So this is really, this is really pretty exciting, and it's almost really counterintuitive because, again, we're not sitting there deciding whether or not, how do we feel intuitively or emotionally about this startup, or do we kind of like the CEO? No, it's much more about certain criteria. So, and then we know which investments are for us and which ones aren't.
So, Thomas, a question, I guess, in this age of search engine optimization, right, you can do all these things to get better results on Google. Is there a corollary to growth science? Are there ways to spin my company to do better on your analysis?
Yeah, well, I suppose, it's probably, probably possible to lie to us and game the system, but, we haven't given up on other forms of diligence. So in other words, while the models are the primary driver, my team is really, really good at, the partners. We still look at things like, is it true? Are you cooking the books? You still need to do traditional diligence. But the real difference is the algorithms are sort of deciding whether or not, you're in the game as opposed to just some vague, feeling or gut instinct.
And Thomas, I went to one of your seminars on the growth science, and I remember the part about how you really look at the market and really kind of niche, a participant or a company you're looking at to see if they really are innovative. And you had all these levels. I mean, is that really a critical piece of this? Is where they fit in the overall scheme of the marketplace?
Yeah, exactly. And it turns out what our models, to give away a little bit of how our models work, I would say if it was 80-20, 80% we really look actually at the market itself, and 20% at the business itself. There's this great quote by Herb Simon that says, look, when you're trying to understand complex systems, for example, you look at ants crossing a beach and the little lines that they leave with these ants. And there's all these complicated detours, and it looks very complex and intricate, when you look at all these lines of the ants. But really, the ants are just sort of looking for food, and they're trying to walk around the little hills and obstacles in their way. So oftentimes, if you want to predict the behavior of the ants, it's more instructive to actually focus on the contours of the beach rather than the ants themselves. So that's not to say startups are ants or mindless drones or anything like that, quite the contrary, but often looking at the contours of the marketplace and how it's shifting through time, you can get a much better tag on whether or not a specific business is likely to succeed or fail.
Well, this is very exciting, Thomas. So is this fund, this Ironstone, is this something that I as an investor can buy shares of, or like a bond or a mutual fund, or how does it work?
Well, I don't think the shares are marketable anymore. So they're all, I think they're mostly, they're sort of all held by the organization, by the entity.
Mm-hmm.
So until we raise more money, I guess the question is no. But the nice thing about it is, one of the unique things about this fund is we're just looking for these disruptive companies that fit the model, but we're not under any kind of unhealthy pressure to do deals. So a lot of venture funds sort of, they raise their $100 million from some pension fund, and they have a few years to allocate it, or they get dinged, which causes you to, sort of panic, right? You have to do a lot of deals.
Yeah.
In our case, we have a great funding situation where, we're just looking for the right companies. If we do 3 deals this year, great. If we do 30, great. It really isn't a question of how many deals. It's a question of the right deals, which is really, I think, really fun and really wonderful way to go. The other thing that's really great about this is taking a long-term perspective for the companies that we decide to invest in. So a lot of VCs, it's kind of like flip this house, right? They put some money in a company, and 5 minutes later they're trying to sell it, right? And a lot because they need that exit to get paid.
Right.
But sometimes that encourages really bad behavior. In other words, they'll say, okay, we're going to give you money, but we want you to have a nice office and hire all these people and do all these things that would increase your valuation and make you sell for more. But when you do that, sometimes you're making sure that the business will never be profitable, right? It's getting so big relative to its revenue that the break-even point is, sort of out into infinity. So if the business doesn't get acquired or go public, it's sort of crushed underneath the weight that it's built up. So what we're doing is actually we're doing the opposite. We're looking for the right companies. We want to invest, and we want to be with those companies as long as they have disruption left in them. So as long as they're on that disruptive S-curve, we want to stay partnered with them. That could take years and years. So even if, for example, the company did go public, we might not choose to sell our shares, right? I mean, why? If the company is still disruptive, it makes a lot of sense to just keep holding the shares. In the case of Google, after they went public, most of their growth has been after the IPO. So why would you sell it at the IPO itself? So again, what's really nice is we have a really long-term perspective. We're looking for the right companies, and we're not trying to give them any kind of unhealthy pressures to inflate the business or sell. We really want them to build solid, disruptive businesses, and we really care about that long-term with them. So it's nice. We sort of aligned our incentives with those of the company.
So this is really exciting, Thomas. I just have to ask before we go, as a wrap-up, have you run your analysis on Ironstone itself?
Well, that's an interesting question. Yeah, I'm going to say it's going to be successful, and that's my story, and I'm sticking with it.
Yeah.
But you'll find out. We already have. We do have an investment in Tango right now, which is the mobile video conferencing. And they, it's funny. A lot of people haven't heard of Tango yet, but they have about 80 million users. I mean, that's not bad, and they only started a few years ago. So we already have some investments out now, and they're talking to entrepreneurs. So if there's some entrepreneurs, an awesome disruptive opportunity, the shingle, the shop is open. We'd love to hear about it.
Well, great. I'm afraid your phone might be ringing off the hook on that, but it's just very intriguing to have something more like science to base these investment decisions on, Thomas. And I want to congratulate you on your move to Ironstone.
Yeah, thanks. It's kind of, I mean, I'm a data scientist at heart, right? And this is like the data scientist dream, right? Right? You get to really use that in the real world with real business decisions. Hey, for me, it doesn't get any more fun than that.
Well, terrific. Well, Thomas, I want to thank you once again for coming on the show today.
Thank you, Rich. It's been great talking to you.
You bet. Okay, folks, that's it for the Rich Report. Stay tuned for more news and information on the world of startups.